please welcome to The Appointment. My guest is someone who just recently catapulted himself into the big league of bankers in India. I'm referring to Mr. Uday Kotak. He's now the third largest banker in India after ING Vaishya falling into his plate, and more importantly now, perhaps getting even bigger with him getting involved with Airtel in the payments bank. But all that and more from the big man himself. Let me welcome Mr. Uday Kotak to the show. Thank you very much, Mr. Kotak.
Delighted, Lata.
Well, but before I get into the micros of your own game, you're going to be hosting this conference, Millennium Makers of India. This is a little different from all the other investor conferences I've heard. What are you going to say, or what are you going to seek in this conference?
You know, Lata, we are in a very interesting phase of India. I am a believer that a number of people have made India happen till now. So we call them the makers of India in the corporate sector. And therefore, the theme of this conference is Millennium Makers of India, because I am a believer that a very significant portion of making of India is going to happen from here. Okay. Therefore, so this is a time to rejoice.
Made India this millennium.
Correct. And some of them will also be key architects for the future making of India.
Okay. Something important has happened in the sphere of banking itself and of course the economy. You didn't get a rate cut from the governor this week, but then to be fair, we just got one 2 weeks back. What's your own sense? Are we likely to get many more rate cuts this year? And is it really all that important?
You know, the RBI under Governor Rajan is what I would call as a purist RBI. Approach is first data. And this is Booth School economics, which is I will act on the basis of data I get. Second, very clear roadmap about what one can expect. Say 1.5% to 2% real rates. Therefore, give me data on inflation, make it convincing, and I'm ready to move.
Okay, so how would you therefore assess? Do you see enough evidence? I mean, you're a veteran economy watcher as much as you're a market watcher. Are you getting a sense that we have seminally conquered inflation and therefore you can reasonably expect rates?
I think it's still early days, but I do believe that the global deflationary pressure will help. And if I was taking a call end December, assuming nothing changes in the world, my bet on CPI is between 5.5 and 6.
So a couple of more rate cuts in that case. But you are not passing it on. You have not reduced any of your rates.
We will certainly consider it, but there are various other factors at play.
What is blocking the transmission?
The first is the RBI over the last few months has now introduced LCR, liquidity coverage ratio, which means banks have to hold significantly higher levels of liquidity compared to earlier times, and there is a price for LCR. So banks now have to factor in the cost of LCR within its base rate calculations. And to be fair to the RBI, they have allowed banks to come out with a new model for base rates based on the new facts which are now required. When base rate was originally introduced, there was no LCR. So we have to factor in LCR in our cost of funds.
But along with it, you've also got some incentive, some reduction in SLR. 2 SLR cuts have come over the past
But look at SLR
months.
and LCR together. The reason why SLR
How much
cuts,
have you to hold together with LCR? And
because LCR, let me just give you this.
9%.
When SLR was 22%, LCR effectively MSF, which was allowed, was 7%.
Yes.
That is 2 plus 5,
yes.
Which means 15% of SLR, and please keep in mind, SLR is statutory liquidity ratio. 15% of the SLR is not considered for LCR.
Yes. Okay. So you think now you have to wait for SLR to fall significantly before base rates are cut?
We are watching the situation. We are looking at, of course, there is a 25 basis points repo rate cut, which is important, which has to translate to lower deposit rates, which we are seeing early signs of. If you look at retail deposit rates, which used to be at 9% for most banks, now they are 8.75, but the transmission has to happen. And combined with that, we have to factor in LCR in our new base rate calculation. And post that, we will be able to take a judgment call of when we can justifiably say that our cost of funds has sustainably come down.
Okay, for the system, when do you think money gets cheaper for, when do EMIs fall, for instance?
In my sense, March or early next quarter is when I see
slack season.
I see the possibility of rate cuts by banks. Therefore, either post-budget, therefore in the month of March, but keep in mind March is again a busy month because you have tighter credit policy. Banks will be reformulating their the base rate policy. So either March or first quarter next year, as things stand today, I believe transmission should happen.
Okay, let me come to the other big announcement, at least for me, that came from the credit policy, that banks have been told that if a project is stalled and you change the promoter to a better one, then you get 2 more years before that loan is marked as an NPL. Is this a revolutionary change? Do you see activist bankers? I
think it's a good change, but let's see which bank can remove which promoter. I think it's a space to watch. And Indian promoters are also fighters, so it's going to be important to see whether this really plays out.
Okay. No, the RBI seems to be empowering bankers to do whatever they can or they must to, improve the functioning of their borrowers. The convertibility clause also is now going to be probably rewritten to allow them to get an equity control.
This is the first time I am seeing in Indian banking that the central banker is rightly saying that equity owners must take the first pain before the debt owners take the pain, which is back to my belief that we are seeing a pretty pure way of looking at things, that equity owner first before lenders take the hit.
Well, let me approach the same thing from a macro angle. The RBI has done this to enable bankers to get more power. They've also introduced the rule whereby you can restructure infrastructure loans in such a way that you only give for the first 5 years and then reset it for the next 25. Along with all this, do you think infrastructure is getting out of the woods, or is it going to take a long time?
Not yet. It's going to take time, and this time around, I am a believer that between now and end of March, a lot of banks will restructure loans because this is the last window they have. I give credit to RBI for taking a position that no further restructuring from April 1, and beyond April 1, recognition of reality. Therefore, in many ways, the stress situation, which was postponed over the last 3 or 4 years, the day of reckoning is coming in 2015.
Okay, so we are likely to see a quantum leap in NPLs even in the next quarter, even in the first quarter of FY16.
In my view, early recognition for banks is important. The issue and the challenge is the next step, particularly with state-owned banks. That if they start recognizing the reality on their balance sheet, how will they recapitalize themselves? Wherever they've got higher ownership, significantly higher than 51, they can go to the markets. But what happens 1 year later or 1.5 years later when you hit 51?
Okay. Yes, there is that trouble, and banks, the government has to take a call on that. Maybe it will take, an important decision of reducing its stake. Let's postpone that. I'm more interested in actually capex or growth taking off. As you say, you are not seeing the stuck projects restarting anytime soon. Then where is the growth stimulus going to come from, Mr. Kotak?
My sense is there is a natural bottoming out in many sectors. And as the RBI gradually reduces interest rates and banks start transmitting it, we will see some floor to the downside in many sectors. And at the same time, this is an economy where there's a very large percentage of population whose consumption demands are increasing. And the real challenge for the Indian economy is how do you move to an investment-led GDP away from a consumption-led GDP?
Okay. Yeah, so therefore the budget becomes important. Do you see the budget being able to trigger investment in any fashion?
I think the budget can help, but And that's where the vision statement and architectural framework from the government is important. The issue at hand is who is going to make the big investments?
Exactly. Do you see the government being able to, I mean, they've got some space with subsidies being released, but the international community is very clear that we cannot, renege on our fiscal deficit numbers. So do you think the government will have the space?
I think the government will have to figure out how to kickstart investment. I think government companies is one option. So NTPCs, Coal Indias of the world, how do you get the investment kick-started? So the government will have to take a lead. The second category, which is the whole promoter-driven and public-private partnership model, I think has got significantly challenged. And there is no easy solution. And a lot of the Indian promoters have got the equity significantly eroded. So where is the equity coming to support the next round? And frankly, from the global side, we may be getting portfolio investment, but long-term FDI in infrastructure, I'm not seeing much of yet.
Well, on that note, let's take a break. Thereafter, I've got many more micro questions about your bank itself and the banking space. We are back in a minute with Mr. Uday Kotak.